Welcome to the Wealth Studying Podcast. This is episode 499. Today is November 16th, 2025. I'm your host, John Pugliano. I'm also the founder and money manager at investablewealth.com. In this episode, I'm going to merge two concepts. I'm going to cover some of the stock purchases I made earlier this week, and I'm going to do that under the guise of the bigger topic, which is the question I've been hearing from a lot of people is, when should you buy the dip? Are we in a correction? Are things going to get worse? Listen, nobody can predict the future. I'm going to tell you this. If you're waiting for a correction, well, it's already happened. The S&P 500 right now is in correction. It's hiding that way in plain sight. And while I don't know whether it's going to get worse, I actually think that based on all the negative headlines you're seeing, it's showing how overall resilient and strong maybe not so much the economy is, but certainly how much the stock market is. So why do I say the S&P 500 is in correction? Well, if you look just at the index, which in recent years I've advised to not do because it's gotten so distorted by, a dozen or so big stocks. The index itself is only down a little more than 2.5%. Overall, that's encouraging. It's also encouraging that really since June, which is when I've been waiting on a pullback since June, well, it just hasn't happened. I don't think the index has gotten down more than, maybe 3.5% or something since June. And every time it has gotten down, it's bounced off the 50-day moving average, which is, again, right around where we are right now. Not to say that things can't get worse. I don't know. But in terms of buying a dip, we're pretty much in that range, because if you look under the surface of the S&P 500, it's already there. 65% of stocks in the S&P 500 are trading 10% or more below their 52-week high. That's essentially the definition of a correction. And you've got well more than half the stocks in that position. And if you want to dig down a little farther, in terms of a bear market, you've got 34% of S&P 500 stocks that are trading 20% or more below their 52-week high. Looking at the moving averages, you see a similar story. 44% of stocks are below their 200-day moving average, which in effect means that, roughly, if you were dollar cost averaging in over the last 12 months, you'd have paid a higher price than if you just bought it today. As far as near-term moving averages, the 50 and the 20, you've got over half stocks. About 57% of stocks fit into both of those categories. And when I talk about this correction, I'm not just talking about smaller stocks, because top of that list, companies that are trading below their 200-day moving average, familiar names: Meta, Visa, MasterCard, Netflix, Costco, Home Depot, Procter & Gamble. I could go on and on. My point here is not to run out and go buy those particular stocks. I just want to point out that if you are waiting for a dip, more than half the stocks are already in one. So don't wait for things to necessarily get worse. Go out and pick companies that you think are fundamentally sound and are likely to benefit from future trends. Buy those stocks now, put them away, and don't look at them for a year. Speaking of buying positions, if you're on my alert email notification list, you know that earlier this past week, I did buy a few stocks, or actually mostly it was ETFs. Before I get into those, I do want to make a comment about ETFs. In recent years, going back to 2018 or so, when discount brokers stopped charging transaction fees on individual stocks, it really swayed things in favor of buying individual stocks and effectively creating your own ETF. That's pretty much been my posture since then, with some exceptions. This past week was an exception. I bought 3 ETFs. The reason for that is that I think that those particular ones that I chose offer the advantage of a sector-focused ETF without overcharging for the fee, because they do charge a management fee, and that's really the reason why in a lot of cases you're better off just picking the stocks you want and you wouldn't have to pay the management fee. The problem I have with most ETFs, that's not true, not most, but many ETFs, is they're really not what they say they are, or they don't offer you the amount of diversification, or the other way, the amount of concentration that they let on that they do. What I mean by that, pull up the ETF XLY. This is the Consumer Discretionary ETF. It sounds good, right? You want to invest in the consumer discretionary sector. You don't want to go handpick the stocks yourself, so you buy that ETF. The problem is that I don't think you're getting much diversification within that category, because if you look at the top 10 holdings of that ETF, that's where 70% of the money is. Worse than that, you have almost 50% of the entire ETF in two stocks. That's Amazon and Tesla. Those two combined represent over 43% of the money invested in XLY, which is supposed to give you consumer discretionary exposure. I would argue it pretty much just gives you exposure to Amazon and Tesla. So why not just go out and buy those two stocks? In any case, that's an example of why I'm not necessarily a fan of ETF investing. On the other hand, this past week, I did buy into 3 ETFs. I think they do give you broad exposure into the sectors they represent, and those are KBE, which is a large bank ETF, KRE, which is a regional bank ETF, and KIE, which is the insurance sector. Now, I specifically bought into those 3 ETFs and one other stock. I'll get to that in a minute. I did it for the following specific reasons. Number one, this had nothing to do with market consideration, but specific to my own portfolio management. I have had very limited and minor exposure to the financial sector. So my number one reason for making this purchase is that I wanted to invest into that sector because I don't have many holdings in that area. And then the other reason is I think that that sector is going to do well into 2026. Those reasons are pretty straightforward. Number one, deregulation. This current administration has made a lot of changes, which I think are going to generally help the overall economy, especially the stock market, in terms of overall deregulation. And then specifically, they've made a lot of changes to the banking sector regulations, which have really been holding that sector back since the great financial crisis. You're talking a good 17, 18 years of underperformance within the financial sector. I think that's possibly going to change. Along with that deregulation is not only the impact it can have on specific corporate profits, but I think it'll also encourage mergers and acquisitions within that category, which again will help stock prices. Now, it's not all about deregulation and mergers, though. I also think that of all the sectors or all the industries, the fastest adopters of artificial intelligence and getting a benefit from the productivity of artificial intelligence will be the financial sector. You're already seeing that when you hear the CEOs talking on their conference calls, on their earnings releases, and also how they're announcing different layoffs and restructurings within the labor force within that sector. So again, this is another way of investing in artificial intelligence, but not investing directly in the chip companies or in the hyperscalers. You're focusing on the companies that are applying that technology and going to reap the benefits in terms of rising profit. And then finally, to a lesser degree, the reason I like financials into 2026 is because I do think we will see lower interest rates into the new year. And while I think this has the least impact on profits, lower interest rates should create more loan demand and thus more fee-based profits. Pull up a chart of those 3 ETFs, KBE, KRE, KIE. Take a look at how they've underperformed over the years, how recently, I'm talking about this year, they have made some advances, but I think they're still converging and consolidating, particularly around their 50-day moving averages, which tend to be below the 200-day. And my premise is that they're going to break out from here and have a much better 2026, and that's why I want to get exposure to those sectors right now. One other individual stock that I did buy last week is Visa. It's one of those stocks that I mentioned earlier that's a big member of the S&P 500. It's down well below its 200-day moving average. Visa's had a rough time lately with all the talk about altcoins and alternative payments. Hey, bottom line, Visa has been around a long time. I don't think it's going anywhere. These new technologies that are competitive to it are also technologies that it develops on its own and uses to maximize the incredible network effect and the moat around its business that it already has. So again, pull up a long-term chart of Visa. Anytime you see it below a long-term moving average, like a 200-day or even a 2-year moving average, which I think is about where it is right now, historically that's been a great time to buy. Now, I have no idea what's going to happen tomorrow. The next day, I bought Visa as well as those other 3 ETFs. I'm not going to be concerned about daily volatility and price movements. I likely won't look at them again till this time next year. Hey, in any case, just my thoughts. As always, until next time, this is John Pugliano wishing you the very best returns.